Joining me now, Post 9 to discuss, is Jan Hatzius of Goldman Sachs. What's the PCE? It's nice to see you.
Hey, good to see you.
What is the PCE going to tell us on Friday?
Our estimate is 26 basis points, and we talk about basis points now. We used to talk about tenths of a percentage point, but we have, I think, a reasonable idea that it's going to be somewhere in the mid-20s, just based on what we saw in the CPI and the PPI and the import price numbers. So that would represent, I think, a significant amount of progress. I think it's also important to look at the market-based core PCE number, which we think is going to be just under 20 basis points, and that leaves out imputed prices like, for example, financial services, which are extrapolated from stock market movements and may not be really representative of inflation.
The point you make, though, is that it potentially brings these cut conversations back into the forefront because it would theoretically give the Fed comfort in thinking that it could cut rates.
Well, it's a step in the right direction after 3 steps in the wrong direction, or first quarter in the wrong direction. So it doesn't undo what we saw in the first quarter. But if we get continued moves, in the 0.2% range over the next several months, then I think, yes, that will give the Fed comfort and ultimately can still get you a cut by the September meeting.
Remind our viewers, because things change, you've changed your view from time to time. How many cuts do you think we're going to get this year as of today?
We've got 2 cuts, one in September and one in December.
And
yes,
you're sticking with that for now?
We're sticking with that. Obviously, it's always subject to what we find in terms of inflation data, in terms of labor market data, and in terms of the committee's reaction function. I think one other important data point, probably more important, frankly, than the core PCE number, is what we see in the next employment report at the end of the following week. We have seen some deceleration in the labor market. Nothing too concerning, I would say. This looks like a healthy deceleration, but if we were to see more deceleration, I think, again, that would support the idea that maybe we should take a small step down.
Do you think that the economy, as reasonably strong as it is today, can withstand a scenario in which rates remain this elevated throughout the remainder of the year and that they don't cut at all?
Well, I certainly think that's a possibility. Again, it's going to depend on the data. If we find that the economy can withstand a higher level of rates, and if the inflation data maybe continue to surprise on the upside, then I think they could do nothing, and that could be okay. My best guess, though, is that as inflation comes down again and the labor market continues to look more in balance, that they will say, in order to rebalance the risks, it's better to cut a couple of times.
And you don't think that September, which is how you moved your first cut back to, is hindered at all by the election? You don't think that's too close?
We do not, no. We think what matters is really the economic data, and the committee will make decisions based on the economic data and will leave the politics out of it. I would also note, in the last press conference, Chair Powell was asked that question, of course, as expected, and he gave an answer that was, very detailed why they do not take politics into account. It wasn't just a perfunctory, we don't take politics into account, and we take them at their word.
But if we take the calendar, at face value, you've got, let's take your timeline into consideration. So September, we go. The next meeting is the day after Election Day. Can you imagine a scenario in which they cut in November, or is this September, December is your best guess?
I can imagine a scenario in which they cut in November, after the election. I can imagine a scenario. I think it's less likely that they would do back-to-back cuts in September and November unless the economy slowed more sharply. I think the more likely path for rate reductions, by the way, in the U.S. and also in other G10 central banks that are starting to cut, is that they go every other meeting, because it's mainly normalization cuts. It's not cuts designed to, to target or combat a sharp downturn in the economy.